some interesting thoughts on today's topic, which is focusing on loan assumptions versus new debt, and kind of the way that we look at it, the way that the market looks at it, and evaluates the different return profiles, risk profiles of that kind of deal scenario. So, okay, yeah, it's 2:02, and let's go ahead and get started. We're already recording, so I'm just going to go ahead and share my screen. And again, for those who aren't familiar, this is my underwriting model, which is available for free download on our website. Let me just find the chat here. I'll put it in the chat. So if you want to follow along, or if you want to get a copy of this blank model, feel free to do so. Jump over to our website, LSCRE.com. But all right, so what I have here, just to set the stage, is, like I said, I just threw this together 5 minutes before this call. Template deal. I'll just walk you through it so we've got the basic understanding. So typical $20 million deal, 225 units. I just created a simple $100 rent increase on the value add. I'm assuming $6,000 per unit to spend on the interiors to get that $100 increase. Doing that business plan over 24 months because it's a large asset, 225 units. You can see that results in a little over 11% revenue increase. So this isn't a huge value add deal. This is just a fairway, kind of down the middle type deal. I just went real simple with kind of our basic expense assumptions. Obviously, depending on where you are, the type of deals you're doing, you're going to have different expenses. But in all, this is I'd say, a more attractive type of deal available today because just the way I set it up, it's almost a 5 cap going in. We're not really seeing much of that today. I mean, realistically, we're seeing more deals at a 4 cap going in if it has a value add component. So with that being said, with that nice nearly 5 cap going in, the return on cost is 5.78, which is pretty attractive given this risk profile. And if you don't know what I'm talking about and you don't know return on cost, it's super important. And I highly recommend you look it up. I've got some articles on our website about it. And you can also check out my book on Amazon, which will tell you everything you need to know. So that's the business plan. That sets the stage. Now, what we're talking about today, or the focus today, is the debt side. So today, there's some interesting things, as always, happening in the debt market. And what we have modeled here is pretty much a Freddie Mac floating rate loan, which is kind of our go-to stabilized debt assumption. So we've got a 75% loan to value loan. The loan is floating, like I said, so it's a SOFR based loan, which is the index rate, and then the spread is 2.6%. So basically, the all-in interest rate on this debt is SOFR plus 2.6%. Today, SOFR is nearly 0%, 2.61% all-in rate would be where we're at. I'm going to adjust the IO to 3 years, and everything else is pretty straightforward. So you can see, so some of the things to just kind of keep in your head is the IO for 3 years, and we'll look at what that does to the cash flow. And then we've got 2.5% rent growth, 2% expense growth, but 3% property tax. So pretty much just moving with inflation. We're not projecting crazy increases here. But if we go to the summary, you can see return is pretty decent, over 13% net IRR. And again, because the first 3 years of interest only, we've got some pretty strong cash flows here in the first 3 years. And then when you amortize, it drops down. The other reason why you kind of see a decline in the cash flows here is because, as I mentioned, it's a floating rate loan. And what we have here is the forward curve for SOFR. So what we do is we go online, download the market forecast for the future of interest rates, specifically for SOFR, which is the short overnight financing rate. And you can see what we did is we plugged in what the projected SOFR rate is for every month for the next 10 years. And then we take the average of the month of the 12 months for that year. And then that's what you see here on this year over year summary. So you can see our borrowing costs go up over the next 5 years as projected by the market. So that's another wrinkle to kind of just keep in mind. So the things we have to remember here is the total return is about 13.3. And then the average cash on cash is 8.3. And I'd say most investors would be comfortable with this level of cash flow. They get to enjoy, you know, approaching and getting some double digit cash flows during IO. And then you're still over 6% when you amortize. And the goal would be potentially if you and your investors are cash flow driven, you would look to refi the debt around the end of year 3, and you put on a fresh new term of debt, which would give you fresh, 2, 3, 4, 5 years of interest only, which will keep your high cash flows going. So now we're going to switch it up. So you saw this is what our debt assumptions are currently. I'm just going to move them over here. And now what I'm going to do is, instead of assuming a new loan with, Freddie Mac floating rate loan, which roughly are these terms today, I'm going to do an assumption. And so if it's a $20 million deal, let's just say we're going to assume a current loan that's going to be somewhere around, I don't know, 65% leverage. So that's 13 million. So now we're assuming a $13 million loan. So the LTV becomes irrelevant. I can just delete it for clarity. And then now let's say we're assuming a fixed rate loan, not a floating rate loan. So we're going to change that to interest rate. And let's just say this loan was put on a few years ago when interest rates are a little higher. So we're going to say 4%, just to make it simple. So in comparison, in the Freddie Mac floating rate scenario, right, our starting interest rate was about 2.61%, and then grew over time into year 5, going to the low 4s. So an upward trend like that. But here, instead, if we're assuming the seller's existing debt, we just have 4% right away. Now, if you're less familiar with loan assumptions, I just want to kind of take a quick step back and explain why you would ever want to assume the seller's existing loan. And the reason for this is because of prepayment penalties. So this current seller in our hypothetical scenario here with the $13 million loan, since it is a fixed rate loan, it typically has yield maintenance prepayment penalty, which is very expensive to pay off unless you actually wait till the end of the loan. So that's why this seller here in our hypothetical is saying, hey, I'll sell you the property, but you have to take on my existing loan because I can't pay the lender off and get penalized with that 1 million, 2 million plus prepayment penalty. And that's why you, as the accommodating buyer, you are willing to step in there and assume the loan. Now, with that being said, aside from the higher interest rate, which is not the best thing in the world, what really kills you is the IO. So let's say this seller put the existing $13 million loan 5 years ago, and he got 3 years of interest only, and then he's actually amortized for 2 years now. So now the amortization schedule is no longer 30 years, it's on a 28-year schedule because you've already amortized down a couple of years, and of course the IO period is expired. So this, now when you look at this, is a pretty ugly situation. So I didn't change anything on the operations side, right? We're still buying a 5 cap, and we've got a nice value add, and we're stabilizing to a decent return on cost. But if I go to the returns now, we've lost a lot of levered return because our debt is no longer optimal, or it's just worse than the Freddie Mac scenario. So you can see our total returns went down by, what was it? I think exactly 3%. Hopefully somebody remembered that, what the numbers were before. And then now the cash on cash went down substantially. And you can see 3.1, 4.5, 5.4, right? So in reality, this is where I think things get interesting. In reality, if a seller was presenting you this deal, you would likely say, you know what? I'd be willing to pay 20 million for this deal. That's if I could finance it myself. But since you're forcing me to assume this loan, I need to get a discount. So let's try 19 million and see what that does for us. It's still, it's still not enough. I'm sure most of the people in this room would, not be excited about this return and not be excited about this cash flow schedule. So we need to hammer the price further, right? So let's try 18 million. So the seller potentially here is losing, 10, 20% value. We'll see how far it goes. So you can see now things are starting to get better. We're starting to get closer back to our original return. not saying the seller is willing to take this big of a discount, unfortunately, but now you can see we're pretty much back to where we were, with the difference being the cash flows are worse. You can see the starting cash flows are worse actually, but over time they actually come out ahead. These are amortized cash flows, and they're better than the floating rate option because the floater had a gradual rise in rate, and this is just sticking at 4. So in later, it actually looks a bit better. So that's interesting. And so the idea here though is, this example is actually not so bad, where the year one cash flow is 5.5%. A lot of investors would go for that, but kind of what I wanted to show is the idea that you might be able to get a decent return from a debt scenario like this, and we'll just say 13.9 is a good return, but the cash flows are usually what really kind of hold you back. That's the constraining factor. And we see that with deals all the time. This example, it's not such a big deal, but we've also seen sellers want us to assume 5% interest debt, and now you can see, that return may be still okay. Maybe we get a further discount, but these cash flows are really tough, and it's tough to go out to investors and say, hey, 4% cash flow year one, and we're going to grow it over time. It's just a tougher sell. So the idea I want to kind of present, and anybody feel free to jump in the chat or to unmute yourself and we can have a discussion. But what I think is really interesting is the dynamic between total return investors and yield driven investors. And that's where you have this battle. And obviously many investors are a blend of both, right? They're not willing to say, well, pay me in 16% IRR and I don't care about any cash flows in the meanwhile. So it's always a mix. But the idea here is there could be a scenario where you have to assume debt that's pretty ugly and it may really hurt your cash flows. But what that allows you to do is get a big enough discount from the seller that you're able to actually get higher total returns out of the deal than you would otherwise. But you have to suffer with the lower cash flow. And what I've realized, I mean, it's a really interesting strategy, but what I've realized is I talk to a lot of investors, active, passive funds, and surprisingly, while it is kind of a savvy strategy to say, well, I can get creative, take on this bad debt, and get actually a higher return than possible, but I'll suffer with the cash flows, right? It's kind of a more long-term view. I've actually found that most investors are not willing to do that. Most investors are really more yield driven. And I think there's two main reasons for that. One, it's their strategy. There's a lot of investors that invest in alternatives and commercial real estate because they simply like the yield. They like the monthly check, and they don't want that monthly check to be 3-4%. They want it to be 8-9%. Totally understandable, and that's their strategy, and that makes sense. And in some cases I could say, well, hey, are you thinking short term, because here's a deal with maybe 6% cash flows but higher returns, and you're passing on it because the cash flows aren't matching, right? So maybe there's some situations where I would disagree, but that's how many investors think. Now the second way is actually to look at cash flow as a risk mitigant. And I've heard, especially with COVID, a lot of savvy investors, they used to like this strategy of assuming debt where they could actually buy in for a discount. But now, and maybe things are changing as things are opening up and people are less worried about the economy. But when people were really in defensive mode, they were really looking at that strong source of cash flow as a way to protect their downside. And they say, well, if I can get into a deal and I don't know what's going to happen to value, I'm not sure where rents are going to go, but if I know that I'm getting 8% return, I'm happy. And that's a way to protect myself because I have better debt service coverage ratio and all that good stuff. So I found those to be two main drivers for why people would, essentially give up higher total returns in exchange for better yield, right? So it's a relationship. Am I willing to trade yield for better total returns, or am I not? So to take a quick pause, Matthew asks about how often do you update the SOFR forward curve? So we typically update it, I'd say every couple months. It hasn't moved all that much, but yeah, it probably is better to update it more often, and especially after the Fed meets and when the market adjusts. Um, yeah, there. I mean, the first 2-3 years are pretty locked in. The market isn't gonna switch its views on that very much, just because the Fed has put such strong guidance as far as keeping rates low for the next 2 years. But definitely here's where the volatility is and where the market is going to change its assumptions as it relates to inflation and growth and things like that. So yeah, SOFR forward curve, I think it's a super cool thing to have in the model, especially if you're a floating rate borrower interested in kind of modeling in those cash flows. So yeah, thanks for that question. So if anybody has any other questions, like I said, feel free to just unmute, jump in, or just send a chat. But so we'll keep going on this topic. So hopefully what I was just saying made sense. Basically, ask yourself or your investors as well, are you willing to, what do you value more, yield or total return? Are you willing to trade away some yield in exchange for higher total returns? And we're talking about this within the context of different types of capital structures, but you could also look at it in terms of business plan as well, right? We all know that for a deal with a big value add lift, you might have to buy the deal at a 3 cap and have no cash flow, especially if you have an expensive bridge loan. And in that situation, you absolutely would be trading away yield. You would have no cash flow. But if you can renovate the units, generate a lot of upside, you can maybe get, 20% returns, and that makes up for the lack of cash flow if it fits your investment strategy. So that's another way um, aside from just the capital structure. Emily asked if I have a Twitter. I do not have a Twitter. So sorry. So, okay, cool. So I think this was a helpful example. The other thing I want to show you, since we are here currently with the loan assumption scenario, and again, we chose 13 million back on that 20 million number because that was 65%. But now that we backed the price down to 17, it's actually 76.5% value. So that's really quite attractive. But what I'll do is I'll bring it back up to 20 million and we'll play around with supplementals and also talk about other subordinate financing. So a supplemental loan is really unique to the agencies, Freddie Mac and Fannie Mae. And I actually just in my last newsletter, I'm not sure if you guys aren't on my newsletter, go ahead and, when you sign up for the model download, you'll get on my newsletter. But the last article that I published was about agency supplementals and how they relate to refis and when you should, kind of what are the pros and cons. But anyway, so a supplemental loan is a unique feature for Fannie and Freddie, where if you have an existing loan with them and you've increased the cash flow, increased the value of the property, you can go back to them and get a supplemental loan straight from them, slap it right on top of the existing loan. It's pretty cheap to do, it's fast. And so there's a lot of advantages there. The biggest advantage of it is if you have a fixed rate loan like we have here, right? We're stuck with this fixed rate loan that we can't prepay due to the prepayment penalty. So there's nothing we can do about the $13 million senior loan. But what we could do, assuming the cash flow supports it, is we could go back to the lender and actually get a supplemental loan, maybe up to 14 million or 15 million to gross up the leverage. So what we'll do there is we'll now start playing with the supplemental and we'll say, yeah, we have a supplemental. I'm sorry, we have a senior loan at 13 million, but let's say the lender's willing to gross us up to 75% all in LTV. And the way that the interest rate on a supplemental is priced is it's 100 basis points or 1% over the prevailing rate. So this is a really good example of that, because if we're assuming this old loan that has a high 5% interest rate, but today, let's say fixed rates are 3.25%, the supplemental would be 4.25% or 1% over the prevailing rate. So we actually can get a supplemental loan that's cheaper than our senior loan, which is a rare thing as well. And then the terms are going to match the senior. There's no IO period. We're going to match the amortization. The fee is 1%. And the nice thing about a supplemental is you're paying a 1% financing fee on the supplemental loan amount, which might be, let's say, $1 million, rather than a refi where you'd actually be paying a debt fee of 1% or thereabouts on the entire new loan amount. And that's where the big savings come from, right? In a refi, you'd have to pay the exit fee or the prepayment penalty on the existing debt, and then the going in financing fee on the new debt. That's a lot of cost. So it could be, just kind of if you have to pay fees going out and in, you're looking at triple the cost on a refi in many circumstances. And if you've got a bigger prepayment penalty, it could be obviously a lot more. So now that we've got this supplemental in there, here's how it's looking. So with a total purchase price of 20 million, the senior debt again still is 13, but now up to 75%, we're able to put a supplemental of 2 million on. And that really helps the deal from a leverage perspective, because with such little debt, you have to bring a lot of equity to the table, which is hard for various reasons. It's hard because your returns are lower because you have less leverage, and it's hard because now you have a lot more equity that you need to go out and raise at these lower returns. It's a double whammy. So getting that supplemental is important, but the problem with a supplemental scenario is you have to make sure that the cash flows support it. And you can see here by adding on this additional $2 million of debt, even though it's cheap at 4.25%, it's amortizing and it's really hitting the cash flows. And so it's a, this is for many people a no-go scenario, and you need to either, accept the lower leverage, get a lower price from the seller, or just walk away from this deal. So because these cash flows are so ugly. So when you look at a situation like this, you need to evaluate your options and see what you can do. See if there's a different structure. Maybe instead of a supplemental, you could do a preferred equity tranche on top of the senior that has a substantial portion of deferred payment. So instead of having to pay ongoing interest, it could be deferred 3 years down the road or even longer. So that way you can kind of enjoy as much cash flow as possible, and then create value on the back end, and then pay off the pref lender and kind of match the business plan. So question here, what are typical sources of supplemental loans? So that's a great question. And as I mentioned, right now we're focusing on agency supplementals, which are a very unique product. It's I'm not aware of any other product where you can go back to the same lending source and just, basically as of right, baked into the senior loan docs, you can go in and get that supplemental loan piece. But yeah, there are plenty of other options out there. The options are out there. The issue is the fact that a lot of senior lenders don't allow those options. So specifically, if we talk about, the main source of permanent debt in multifamily, which are Fannie Mae and Freddie Mac, they're very picky about allowing, subordinate debt or mezzanine loans and even preferred equity. So anything that's subordinate or supplemental, they either just don't allow, or they're very picky about how it's structured. And so you have to work closely with them, and it becomes kind of a delicate dance of, if you're the pref or the mezz piece in the middle, you have to negotiate with the borrower and you have to negotiate with the lender, and all three have to work out. So that is, it is an added complexity on the agency side. CMBS loans are, they're similarly challenging as well. But in terms of owner financing or things like that, the best way to structure, if the owner is open to it, and you're doing an agency loan, is to set it up as preferred equity. I advised on a deal last year where that's exactly what happened. The seller came in on the deal, essentially owner financed it, but we structured it as a preferred equity loan to the property. So it was approved by Fannie Mae, and we got the deal done. So not easy, but absolutely doable. Thanks for that question. So another question is coming in, and the question is, if you are assuming a tier 3 loan at 65% LTV, would the current lender let the new buyer get a supplemental based off of a 70 or 75% tier 2 LTV and get more leverage than originally? That's also a really interesting topic. And if you're not familiar with the tiers, Fannie Mae has essentially a tier 2 loan, which is 75 to 80% leverage, and then a tier 3 loan, which is 65% leverage. And, the benefits of, let's say, doing a tier 3 loan is you could maybe get full term interest only and a cheaper interest rate and things like that. So what you can do is you can upfront in the loan docs, if you are doing a tier 3 upfront in the loan docs, you can negotiate the supplemental to be allowed to go up a tier. So you say, okay, I'm borrowing 65 today. And in a normal circumstance on a supplemental loan, you'd only be able to reborrow up to that same leverage point. And the only way you'd get more debt is assuming you created a new higher value for the property. But if you actually upfront in the loan docs, get that approved that you are able to get a supplemental over and above the existing leverage, right? Going from tier 3 to tier 2 as implied, then you can do it. And it costs, I believe, somewhere around 5 to 6 basis points on the senior loan. So let's say you're borrowing 3.5% today and it's 65% LTV. And in the future, you want to borrow up to 75, you might pay 3.55% today, a little bit extra. And it's a really interesting topic. Not something that we really deal with because we're not a tier 3 borrower. We wouldn't, unless we're really forced to, we wouldn't really look to borrow only 65% LTV. So yeah, interesting stuff. Awesome questions. So yeah, I am just freestyling here. So if anyone wants to lead the topic or we can completely shift gears, I'm open. Like I said, very open to Q&A. I'll leave the last few minutes open for just a quick commercial on everything that's going on with us. But yeah, that's, feel free to jump in. This is the time. And if not, I will do my quick little commercial.
Hey, Rob, I have a quick question for you. So with interest rates being so super low these days, right? Would you see that there's going to be a wave of loan assumptions 2, 3, 4, 5 years down the road?
Yeah, it very well could be. That's what people have been thinking for a while, right? They think, oh, interest rates are low. They're never going lower. It's a great time to lock in. And then I'll actually have embedded value or intrinsic value in my debt in the future as rates go higher. Which is not wrong, but what's happened is, they've been wrong. It's interest rates have just gone lower and lower than what people thought is possible. And I'm not saying interest rates are going to go lower than where they are today, but that's just what's happened in the past. Moving forward, I think we are due for a modest increase in rates. And so people who are locking in rates today likely will, have some intrinsic value in their debt. And so then it'll actually be a benefit to, or at least a more complex analysis if it makes sense to assume the loan, because at the end of the day, even if the interest rate's attractive, assuming the loan, it might be at a lower leverage than what the buyer wants, and it might not have the interest only that the buyer wants. So that makes things tricky. But it's really interesting point, because 99% of the time that an assumption happens, it's because it has to happen. It's because there's a yield maintenance penalty, and that's the only way that the deal can get done. But it would be really interesting to see deals happen where the buyer chooses to assume the debt because it's more attractive than what's available in the market. So yeah, it's a good point. Clive's asking, does the model show year one? I think that's referring to year 1 and year 3 debt yield. So yeah, on the pro forma tab, you can see the debt yield spread across the years. Okay, so I'm going to jump, keep the questions coming, but I'm going to jump into my quick commercial. So yeah, wrong commercial. Still the wrong commercial. Here we go. So if you aren't familiar with me, my name is Rob Beardsley. I am the author of the definitive guide to underwriting multifamily acquisitions. I think this is a great resource if you're starting out, or even if you're more advanced. There's definitely some nuggets there that people come and tell me, say, wow, I've been doing this for years, and I took away something new. So definitely check that out. And on top of that, just to be completely honest with you, I poured my heart out into this book, and I, don't think I really left anything out. It's not like I was purposely trying to hold anything back. Um, but there's only kind of so much you can put in a book. And so, I finally created an underwriting course that, so many people were asking about. So you can check this out as well at just uwmastery.com. Um, here's just, it's basically a Kajabi course. Inside I've got, many hours of recorded content where I'm doing something just like this, but going real step by step. So that's my quick commercial on that. And then my next commercial is on our in-person event in October in New York City. Would love to have you if you are a sponsor looking to build your business, build your relationships, learn more about topics such as raising institutional capital. We're doing a negotiation workshop with world-renowned Professor Stuart Diamond from Wharton, and plenty of speakers where you can hear exactly what investors who are managing large funds are doing with their money today. So check out that at launchpadevent.com, and feel free to reach out if you have any questions. And then I promise the final commercial is our current investment opportunity, Solano Apartments. If you're a passive investor, would love to talk to you about this deal. We've got the webinar, we've got the underwriting walkthrough that I sent out this morning. And so this is just another bread and butter fairway deal for us. And feel free to reach out if you have any questions. So that is my commercials. And thank you so much for sticking with me to this point. Like I said, I have to jump off early today. But happy to stick around for another 10 minutes if anybody's interested to answer any more questions or go into any other topics. We still got time to share the screen again and cover anything. So let me know, or we could shut it down. Let me know.
Hey, Rob. So thanks so much. I also read your book. Great book. Just a lot of insight. I've been in the investing space in multifamily for about a year now, so I'm relatively new to it coming out of the single family space, but it was a great way to, help me learn for sure. On the yield that you were just looking at just now, can you expound on that a little bit in terms of when you're talking about the yield spread? I know your book had talked about the yield on cost versus, your exit cap rate. Look like there's a spread there too. And so I guess my question is, the yield that you look at under the performer, was it the performer tab just now? Does that correlate to that spread that's between the yield on cost and the exit cap?
Okay, yeah, absolutely. So what we were covering just a second ago was the debt yield right here. That's what you were mentioning, right?
Yes.
Yeah. So the debt yield is really a lender focused metric where the lender looks at the NOI divided by their loan amount, and they're seeing how much yield the property generates relative to their loan. And so kind of the best way to understand a debt yield is if the lender had to take over the deal at their loan amount. So at the lender's cost basis, if they had to foreclose and own the deal, what cap rate would they own the deal at? And that's the debt yield. So some lenders focus on debt yield, other lenders focus on debt service coverage ratio. That's what debt yield is. Now going to return on cost, I'll go back to this tab. As we were talking about from the very beginning, the return on cost here is a measure of your stabilized income divided by your all-in costs of stabilization, right? So what are the costs associated with you implementing your business plan? Well, first you have to buy the deal. So you have your purchase price, and then you have your construction costs or, CapEx and things like that. And some people choose to include other things in their yield on costs, like closing costs. I don't think we include that, but we do include interest reserve. So if we have negative cash flows that we have to essentially fund ourselves to make the business plan happen, we'll factor that into the return on cost, because those interest reserves were a factor in getting us to that yield on cost. So yield on cost is a really great metric to just kind of see that unlevered return potential. It's just a smarter cap rate, right? It's the future cap rate that you're going to operate at. And the key, like you mentioned, is to have a return on cost that's greater than your exit cap rate, because that means you've created real value in the market. Because if I'm going to go through all this effort in renovating and doing a business plan, and I'm only ending up at the market cap rate, then why did I do all that work? I could have just bought a property, stabilized straight up, and it would have had that same cap rate, and I would have avoided the risk and the headache of the business plan. So when you are going after a business plan where you are adding value, you're raising revenue, this kind of thing, you need to have that premium. You need to have that increase in cap rate to make it make sense on a return basis and on a risk basis. So that's important.
So is talking about the market cap rate. So is your market cap rate, is that your underwritten, is that the middle one, your underwritten cap rate, where you add 50 basis point to get to your terminal cap rate here? How do you determine your market cap rate from here?
Yeah. So usually this middle one is not a good representation of the market cap rate. And that's because usually if you're buying a value add plan, you're buying a compressed cap rate to the market or to the stabilized. So, yes, in this model, you see this is a simple formula of 50 basis points over the middle one.
Right.
But it's really not, I'd say, not the most accurate, or, it's not the reasoning that we usually would want to take. What we would want to do is we want to know the market. We want to know what's going on. And we want to know that based on our data that we're collecting, which we collect data from all the deals we underwrite, and we capture, what cap rate the deal is, what return on cost it is, all this data. So we know what cap rates are in the market. So we know what the market cap rate is. And then we'll apply, maybe 50 basis points on that, or even tighter these days, just because things are so competitive. So that's how we view that analysis, to come up with kind of the market cap rate, and the terminal cap rate, again, as we all know, should kind of have a little bit of a buffer. So really what we're saying here, if we're looking at the exit cap and the return on cost, is we've got a nice big buffer. We're going from market cap rate to a little expansion to the exit cap rate, and then our return on cost is even more than that. So that's what you really need.
The aim to have the return on cost more than the exit cap rate. Definitely.
That means we're creating value upon a sale, because if we have cash flows that cost us, so the math is a little inverted, but if you can understand that if we built a stream of cash flows equaling to 5.78% with our cost basis, yet the market values that stream of cash flows at 5.45%, we'll say, then those cash flows are worth more to the market than what it cost us to build it. So that's our appreciation right there. And that's what you have to have, or else you're not creating value.
Right. That makes sense. Yeah. And so you make an interesting point in terms of the, I'll let go after this, let somebody chime in, but make an interesting point regarding your yield on cost cap rate, in that you don't include your closing costs, but that sometimes can be up to 3 to 4% of your purchase price, which is a significant amount of funds depending on the price asset you're purchasing. So do you think that that impact the returns at all?
It's a great point. So at the end of the day, the closing costs are factored into our model, right? We've got our closing costs here. We know we've got cash reserves. We've got the debt fee. I mean, it's all factored into the actual, IRR and the cash flows.
Okay.
But in terms of the return on cost, I'm just looking at my formula here. We got purchase price, capex, interest reserve. So we don't include the closing costs, and it's personal preference. I mean, I'm sure other people do. And this is why I tell people that, don't just accept someone else's numbers, because they might have a different style than you. And if you need to do it your own way that makes sense to you, and keep it consistent. So it doesn't really matter which way I decide to look at things, as long as I do it consistently, because then I can compare apples to apples across all the deals.
Right. Okay, Rob. Thanks so much, man. I appreciate it.
Yeah, absolutely. So got a nice long follow-up from Mark. Let's check this out. So if I'm looking at a value add deal that has a going in cap rate, a little compressed of 4%, but the market is at 5%. And assuming we're going to do a big upgrade to stainless steel appliances, granite countertops, of 30% of the units, and also plan to leave meat on the bone for the next buyer, would you ever feel comfortable basing your exit cap off of a more favorable going in cap rate, essentially a compressed going in cap rate to reflect the future upside that we're leaving for the next buyer, instead of that 5% market cap rate, and then adding, the 50 bips and all that, and thus being too conservative? Yes. So absolutely, this is the right way to do it. You have to be aware. You have to think about what you're selling when you're selling. Am I selling a stabilized product, or am I selling a value add product? And then you have to put a cap rate on it, right? So to discuss this question in reverse, a lot of people make the mistake of, well, I'm buying a 4 cap, so I'm going to do my value add and I'm going to stabilize the deal completely, and then I'm going to sell it at a 4.5 cap, which is conservative because I'm only going 50 basis points over 4. But that's not conservative, right? Because we're conflating going in cap rate with market cap rate. And so that's the wrong way to do it. And now this is the right way to do it, where it actually makes sense to be aggressive on your exit cap rate, because if you're going to leave all this upside to the next buyer, you have to make them pay for it. So if the market's a 5, you need to, then that's where you actually do underwrite to that 4.5% exit cap rate. And that's a really good strategy. And you've seen a lot of smart investors do that over the last cycle, where they go in there, it's an untouched deal, they'll clean it up, and then they'll get out of it, while only, like, really the sweet spot is renovating, I'd say about 20% of the units, prove out the plan, and then someone will come in there and pay an aggressive cap rate. So that the trouble with that is it doesn't look as good in the underwriting, believe it or not. Even when you use such a low exit cap rate, when you underwrite a deal and you project to fully value add the deal and then sell at a higher cap rate, that still shows a higher return than doing a partial reno and a low cap rate exit. So on an underwriting basis, a full reno looks better. In reality, you're taking less risk and you can get the business plan done faster. You're spending less money to do kind of a leaving meat on the bone strategy. So it's an interesting scenario, and you can kind of decide how you want to go about it. You could essentially underwrite a full reno, have a business plan for full reno, but then when you actually go in there, do 20%, see what the market looks like, and see if there's an exit opportunity. That way you're not left undercapitalized. If, let's say it's a recession and you can't sell, you've got all the capital there to continue out the renovation, assuming it makes sense. So yeah, that's a great point. And that's exactly where we will end. I've got to jump. Thank you so much for providing me the topic of conversation, because obviously I didn't bring much to the table today. So glad to have you on. And this will be recorded. I believe I might have missed that question somebody asked. This will be recorded, and I will send out the email later tonight. So again, thanks again, and have a good one.